A going concern is a business term used by accountants to describe a business that has the resources to continue making enough money to stay afloat for the foreseeable future. This assumption is useful for accounting practices, but it could be overrated in the field of investing. We tend to think that successful companies will be around for a really long time, and certainly some companies like this do exist. Johnson & Johnson, General Electric, and Coca Cola have all been in business for over 100 years, trading as the same company they are today. Even older companies exist if you follow the history of business mergers back to their beginning. JP Chase is the modern product of several bank mergers over 3 different centuries, with the first constituent bank tracing its roots back to 1799. Having early investments in any of these companies would make you a very rich person today, but you would also be a very dead person too, which reduces the appeal of this investing strategy considerably. A recent industry report has found that one of the biggest mistakes investors make is overvaluing the longevity of a company, and it's easy to see why with people like Warren Buffett talking frequently about how much $5 invested into Coca Cola would be worth today. So it's time to learn how money works to find out why businesses that last hundreds of years are not always the amazing investments they seem. This week's lesson was brought to you by Morning Brew. Morning Brew is a completely free email newsletter that gives you the news you need to know in a way that makes it fun to read. Morning Brew has quickly become one of the first things I read when I wake up because it gives me the stories I need to know, and it does it in a way that gets directly to the point. Their stories cover a range of topics like careers, real estate, world news, politics, education, and money. I recently enjoyed reading a story about how paper shortages could be a threat to US democracy. Well, sort of. Basically, the gist is that elections are coming up and there's a paper shortage concern, and election officials are concerned they'll run out of paper. For stories like this and much more, I strongly recommend signing up for Morning Brew. Find out how much more informed your day can be by starting it off with Morning Brew by using the sign up link below. The oldest businesses in the world are not huge financial successes. They are mostly small family-owned operations from Europe and Japan that have run continuously for hundreds of years, never expanding and never taking major risks. These are, by their very definition, businesses operating in very traditional industries like hospitality and construction. In fact, the oldest business in the world is Kongo Gumi. I apologize to my Japanese viewers for butchering the name. The business started in 578 by building temples and was passed down through a series of family and non-family successors until 2006, when it fell on hard times and was purchased by an engineering conglomerate, the Takamatsu Construction Group, a publicly traded company. Kongo Gumi still operates to this day, constructing custom projects like event halls and libraries, but it no longer does so as an independent entity. Rumors surrounding the acquisition of Kongo Gumi suggest that the engineering firm only purchased the company because of its long history and cultural significance, not because of its business fundamentals.
Why did you do that?
The sad story of Kongo Gumi demonstrates the first mistake investors make when they place too much emphasis on a company's longevity: the hot hand fallacy. The hot hand fallacy is a psychological predisposition that humans have to see patterns where they don't exist.
You are crazy. You're a crazy son of a
If a basketball player is sinking free throw after free throw without missing, then a person falling for the hot hand fallacy would expect that the shooter is guaranteed to make their next throw, when the reality is that the odds of them making the throw are completely unchanged by their past record.
This is a classic error.
The odds are affected by the player's skill and how far back they are standing, but their shot history is exactly that: history. Which reminds me that you should all go and subscribe to How History Works. The hot hand fallacy is simultaneously the most ignored and the most recognized mistake that investors make. Most investments even come with a disclaimer specifically to warn people that past performance is not an indication of future results. A company that has been in business for 100 years is no less likely to go bankrupt than a similar company that has only been in business for 10 years, if all other business fundamentals are the same. Their history, just like the basketballer, means nothing. Older companies have some advantages over newer companies: brand awareness, an existing customer base, and established operations. But these walls can do just as much to box in a business as it can to defend it from competition. Investors should really assess a company's business on a case-by-case basis, and it's not good enough to assume that just because a business is 100 years old, that it will continue to operate for another 100 years. Even if continued operation was a sure thing, that doesn't always make it a great investment just by itself. All businesses follow the business life cycle. A business is founded, it struggles to gather its first few customers and investors. If it is able to do that, it grows rapidly before it plateaus out after accessing all of the potential customers it can. From there, it can either launch a new offering to get its business to grow again, or it can decline and eventually close down. The plateau period can in theory last forever. In the case of the world's oldest companies, most of them are of pretty modest size, and it had little pressure to grow because it didn't take on debt or outside investors who want to see consistent returns on their money. Facebook, Meta, is at the pointy end of this cycle right now. They were founded and then grew to be the largest social media company in the world, but now they have simply run out of new people in the world to sign up to their platform, so their business has started to plateau.
Look, I think Facebook has realized, or Meta now, is realized that it doesn't control its destiny. It doesn't own its content because content creators are leaving it right now to go create content on TikTok and taking their fandoms with.
The Zuck wants his business to grow again instead of declining and beginning the process of becoming the next MySpace. Meta's new product offering is the Metaverse, which so far hasn't been a huge success to say the least, but investors can at least see that it's an attempt to stay on the right side of the business life cycle. What Zuck and other established business owners like him wait too long to find out, though, is that there is a benefit of a business dying with dignity, and sometimes it's not worth throwing good money after bad. Zuckerberg and managers like him that are helming companies that must innovate to survive can find themselves in a position where their best personal interests are different from the best interests of their shareholders. Zuckerberg wants to keep his role as the CEO of the world's largest repository of personal information, and investors just want to make the most money possible. If all of these investors were given a choice to put their money towards a new independent startup making cumbersome motion sickness generators and dystopian virtual worlds, most of them would choose not to. But because they are investors in Facebook, they are being forced to indirectly invest in this idea, because Zuckerberg has decided that this is the way the company is going. The alternative would be for Facebook to maintain its current operations and work on reducing costs to make the most money that they can out of the existing social network. This could maximize dividends to investors until the business shuts down or is acquired by another entity that wants its own social network. Zuckerberg's position is slightly unique because he owns controlling shares, which means even a majority of regular shareholders can't vote him out as the CEO. But the story of businesses desperately trying to reinvent themselves is by no means unique to Facebook. Good businesses can grow, deliver great returns, and then shut down in the most efficient way possible so not to waste any money which can be used for starting other good businesses. My good friend Patrick Boyle made a video about a year ago where he spoke of a report by McKinsey & Company, a high-end corporate consulting firm, which found that most of the largest companies in America today were founded only a short time ago, like Apple, Amazon, Microsoft, Google, and yes, even Facebook. If the S&P 500 index was only made up of companies that have been around for more than 60 years, then its performance would have been more than a third lower. This research suggests that not only are companies with long histories no better off than young companies, they are actually significantly worse, and there are two reasons why. Reason one is that old companies tend to acquire corporate baggage as they operate. A company like General Electric, which has been in business for 130 years, will have 130 years worth of outdated processes, agreements, and problems that were too difficult to ever get rid of. This accumulation can also extend a negative company history as what becomes acceptable changes over time. Bayer no longer sells heroin today, but many people only remember it for the time that it marketed that its new product would be a great way to deal with the flu. Think of any old company and you could probably think of something from their past that they would rather the public forget about.
No, forget it.
This process doesn't need to take decades either. To pick on Facebook again, as the company has aged, it has gone from the trendy platform for college kids to the angry boomer convention. Bad history can go beyond just cultural taboos and cancel culture as well. Large companies inevitably become embroiled in scandals, fraud, and other risky behaviors that can be swept under the rug in the short term, but over a long enough time horizon, corporate managers run out of rug. Enron, WorldCom, Wirecard, and Lehman Brothers all started out as perfectly legitimate businesses and operated for decades as such, but over time started needing to cover up their cover-ups until their entire operations came unraveled in massive explosions of corporate fraud and risky business practices. Businesses, like any fine-tuned machine, eventually wear out and it becomes more costly to keep them running than it does to just buy a new machine. The second reason that old businesses underperform new businesses is because they become bloated with staff and operations that are not focused on the company's primary industry. Old large companies spend more time managing themselves than they do improving their product or service offering. The billionaire investor Carl Icahn made most of his money finding businesses like this and stripping out the layers of redundant managers and special side projects to make struggling businesses profitable again. This gave Icahn a bad name as a corporate raider, because most of the time when he acquired a business, a wave of layoffs would swiftly follow. One example that Icahn spoke about publicly was that of ACF, American Car and Foundry, a 207-year-old business that built train cars and then rented them out to rail lines. A simple business, in theory.
Yes, again, in theory.
Icahn noticed that the stock in the company was selling for roughly the same as the amount of all the assets the company owned, which was puzzling to the investor because it meant that the operations were being valued by other investors at effectively $0. Upon buying up controlling interest in the company, Icahn had learned that the Manhattan head office of the company spent very little time on focusing on improving the operations of the railcar manufacturing or leasing operations. Instead, 12 floors of analysts and managers were working on overcomplicated financial systems that even Icahn, a veteran financial investor, could not understand. Icahn eventually met with a plant manager over drinks who told him that his factory would run more efficiently if the head office didn't exist at all, because he spent more time creating reports and projections to satisfy the managers in Manhattan than he did on actually running his plant. Icahn took the suggestion on board and laid off all 12 floors of the head office. ACF was an old business that would not have survived much longer if it weren't for the activists' intervention. It serves as a great example of how old companies are not automatically good companies. The final reason that good companies should not last forever is that endless scopes of operation can cloud investing decisions over reasonable timeframes. Only a tiny fraction of a percent of companies will last more than 100 years, and only a tiny fraction of a percent of companies will ever be worth more than $1 billion. A company like Congo Gumi will have returned less to its shareholders in 1,400 years of operation than a company like Amazon will have delivered in less than 30. When you invest in a company, you should have a clear idea of how that investment will be returned to you. If you are investing in a company that is new, you will want to see a roadmap with a clear schedule for when you are going to make your money back and then some. After that, it doesn't even matter if the business sticks around because you have already covered your base and everything else is just gravy. Older companies are rarely held to the same scrutiny because it's easy to think that it will continue to be around forever. Maybe you can just pick up a few dividends and then just sell it on to another investor if you need the cash. It's a strategy that works well until it doesn't. Good investing is about diversification, because casting a wide net is really the only way to reliably ensure that you gain exposure to the next group of companies that will deliver outsized returns over the coming decades. But diversification doesn't just mean investing broadly, it also means investing regularly. Or you could just screw it and try and make money like a new group of investors who have made their own exchange-traded fund specifically to bet against Jim Cramer. Go and watch my video on the short Cramer ETF to find out how that's going for them. A special thanks again to Morning Brew for making it possible for everybody to keep on learning how money works.